In this lesson, we'll look at the remaining account options. These options are specific to the individual account type being used. The signing bonus attribute is used for annuity accounts and fixed rate accounts. This value is entered as the percentage that the account provider will add to the initial balance when the account is first opened. The yearly income attribute is used to define how much income the account will pay each year. This attribute is only used for annuity and fixed rate accounts. Incomes from managed stock accounts and bank accounts are automatically calculated each year by Plantastic based on the expenses and the other incomes defined in the scenario. The yearly income increase parameter is also only used by annuity and fixed rate accounts. If the account provides an income that increases each year, enter the yearly rate of increase in this field. The income will be automatically increased by this percentage each year, starting in the second year. The management fee attribute defines the percentage that the account manager withdraws from the account each year as a management fee. It is important to separate this out from the overall rate of return, as this cost will still be incurred during the bear market simulations where the overall rate is not applied. The account balance will be decreased by this percentage each year of the plan. This option is used in all the account types except bank accounts. The percent equities attribute is only used by managed stock accounts. It determines how much of the account's assets are invested in equities, with the assumption that the remaining percentage is invested in bonds, cash, or other less volatile investments. This percentage is only used during the years when a bear market is simulated in the scenario. The stop loss and re-entry percentage attributes are used together for managed stock accounts to simulate bear market performance. If you set a stop loss value at less than 100% for a managed stock account, the calculations will start using the specified bond rate of return as soon as the account value drops by the specified stop loss amount. Stop loss values are typically in the 8 to 12% range, but you can use any percentage the account manager offers. Please note, if you don't want to simulate a stop loss on the account, set this attribute to 100%. Indicating that 100% of the account equity balance is subject to loss in the market. For managed stock accounts, this value should not be set to 0, as that would indicate that the entire account would be simulated as bonds as soon as there was any downturn in the market. For annuity accounts, the stop loss value determines the lowest rate of return that the account will allow. A stop loss of 0% would be used to indicate that the rate of return for the year would never be negative. The re-entry percentage attribute is used in conjunction with the stop loss attribute for managed stock accounts only. If you set a re-entry value of less than 100%, the calculations will assume that the account assets are switched from bonds back to equities when the account recovers the specified percentage. For example, if you set this attribute at 50% and the stop loss at 10%, the calculations will start using the bond rate of return when the historical stock market reaches a 10% loss, and then switch back to the historical rate of return when the balance recovers 50% of the loss at the lowest point in the historical market. Watch the tutorial on bear markets for a more detailed explanation of how the rates of return are determined during bear market simulations. The reinvest percentage is used in the years in the plan when the total income exceeds the expenses defined for the year. This is likely to occur in the years when the clients are still earning their pre-retirement incomes, and may also occur in years when the clients have large withdrawals to cover RMDs. The excess for the year is multiplied by this percentage, and that amount is added back into the account at the start of the following year. This attribute is only available for managed stock accounts and bank accounts. In each year of the plan, Plantastic looks at the amount needed for expenses, then totals up the fixed income from defined income streams, Social Security, annuities, and fixed rate income accounts. If the fixed incomes don't provide enough to cover the indicated expenses, the additional amount needed is drawn from the managed stock and bank accounts. When this happens, the withdrawal sequence attribute is used to determine how the money is withdrawn from the accounts. Money can be withdrawn from the accounts sequentially or proportionately, or a combination of both. To explain this more clearly, Consider a case where you have 4 managed stock or bank accounts, and you set their withdrawal sequence attributes to 1, 2, 3, and 3. With these values, all income needed to meet the yearly expenses will be drawn from account 1 until it is depleted. At that time, the income will start withdrawing from account 2. When account 2 is depleted, the needed income will be drawn simultaneously from accounts 3 and 4. The amount contributed by each account will be proportional to the balance in each account. This ensures that one account does not get depleted before the other. You can use any combination of sequences you like, from all sequential to all proportional and everything in between. Careful consideration should be given to this attribute, depending on tax rates, account taxability, required minimum distributions, and rates of return. The length of time the plan can support your clients can vary greatly based on the sequence that the accounts are used to provide income. The withdrawal sequence attribute is not used for annuities and fixed rate accounts, as these accounts provide a fixed income amount. The index cap attribute is only used for annuity accounts. Some annuities set a cap on the amount of growth the account can have in any one month or year. If the annuity you are modeling does not include an index cap, set this attribute at 100%. The index type option is also only used for annuity accounts. It defines how the yearly interest is calculated on the account. If this option is set to monthly, the calculations in the bear market years will add up the rate of return for each month. For negative months, the full negative amount will be used. In positive months, the rate added to the total will be the historical market rate or the index cap, whichever is less. At the end of the year, the rate of return for the year will be set to the total rate for the 12 months, but no less than the designated stop loss percentage. If the index type is set to yearly, the monthly rates are applied with no modifications, accumulating each month. At the end of the year, the rate of the return for the year will be set to the calculated accumulated rate or the index cap, whichever is less, but no less than the designated stop loss amount. Finally, the attribute labeled as income per 100,000 is optional and only used for annuity accounts. Using the income table provided by the annuity provider, determine the yearly income that the account would produce for a $100,000 investment based on the number of years in the accrual period. When this value is entered, it is multiplied by the initial investment amount you specify for the account. As you adjust the size of the initial investment, the yearly income amount will adjust automatically. If you prefer to enter the annual income of the account directly, leave this attribute blank, but remember that if you change the initial investment amount, you will also need to change the annual income amount.